Hello and welcome to Trading Blows from TraderX. Another busy show ahead. In the show today, we will discuss the impact of higher for longer. That message from central banks appears to have finally sunk into the minds of traders, not just in the US, but in Europe as well. Also dig into geopolitical risks as the 1-year anniversary of war in Ukraine approaches. We'll also have a look at equities. They've been relatively range bound of late, how long they might stay in that range and which way we think that range may break out to. And also we'll have a look at some incoming data in the UK and whether that will help to dispel some of the doom and gloom that has been surrounding the United Kingdom of late. Without further ado, let's get into things. So, as I said, a busy show ahead. Without further ado, let's meet our panelists. As always, they will go head-to-head over 4 rounds, scoring points for a great response and some actionable trade ideas, and they have the threat of points being chalked off, looming large over them if a dispute is raised over their answer. Of course, the better the response, the more points they will score. Joining us today, the man with the worst fashion sense in Whitstable, Ryan Paisey, founder of PIQ Suite, market intelligence and news platform. From a cave somewhere in the City of London, Linton, the head of the European desk over at Newsquawk, a provider of real-time audio updates the moment that market-moving news breaks. And from all the way down in South Africa, Arno, while power permits, a market analyst at Financial Source, a developer of proprietary idea generation and market analysis tools for the FX market. With all of that said and done, let's get into the first round. So to me, at least, it felt like last week was the first week that this higher for longer message that the Fed have been telling us for some time really sank in to traders' minds. We had that hotter than expected CPI number on a year-on-year basis, at least, a solid beat on PPI, a decent retail sales print, and another incredibly resilient jobless claims number as well. So if you look at the Fed funds futures curve, we now see a 25 basis point hike priced for March, another 25 basis points priced in for May, and about a 50% chance that we get another 25 bips move in June as well. So I think the terminal rate pricing sits around 5.3% at the moment. Of course, this has led to a significant sell-off in treasuries as well. The 2-year trading around about 60 basis points higher than it was at the start of the month. The 10-year very, very close to 4%. So Arno, I'm going to go to you first because I know you've been talking about this on Twitter quite a lot. Is the market right to be pricing this? Have we kind of gone too far too fast and we think that some of these moves are going to retrace? Because everyone's talking about the US economy going into a no landing scenario, to use that analogy. Are we right, or is everyone getting a bit too complacent?
I think the moves we've seen recently makes a lot of sense, especially if you just look at the data. The data has been absolutely solid. So I think the markets have priced in accordingly. It's also given the Fed a little bit of cover, with their higher for longer theme, because the markets had trouble believing them. So I think the data just helped them nudge in that direction. And if the data continues, I do think, we could see similar price action playing out. I don't really see a need for that trend to change. However, whether that changes the view of a no landing versus a hard landing, I'm not sure. I still think that a hard landing is the higher probability, but that view has been pushed out a little bit. The reason why I say that is it's quite normal in any economic or cyclical slowdown for the data to bounce momentarily. So you can have months, maybe 1 or 2 or 3 or 4 for data to bounce and then return in that overall cyclical slowdown momentum. And I think that is going to happen. If we consider how much the Fed has done, how much they're expecting to do, I just think there's still a ton of tightening that needs to make its way into the economy, and that pain will be felt. If you look at Fed fund futures minus something like core PCE, we've seen that every single cycle from the 80s have required far less tightening to create enough pain to basically cause a recession. And if you use that measure, we're not far from that level where it's going to cause some pain. And consider the consumer, right? We've had really good retail sales data, and everybody's been saying, consumer's still strong and all that. But consider that, personal savings have been drawn down massively. We have, at this rate, we have the highest level of US consumer credit card debt in history. It's close to $1 trillion. We have delinquency starting to pick up from the lows, and that is happening while we have a lot of tightening still needing to play into the economy. And secondly, this is happening while the labor market is still strong. So what's going to happen when the labor market eventually starts rolling over? If that happens, I think it's going to be a hard landing still. So for now, as long as the data keeps up positive, I think this trend should continue because it makes sense. And if it bounces for the next 2, 3, 4, 5 months, we should see a continuation in the recent trends. But I don't think this takes away the probability of a hard landing at all.
So just sticking with you, Arno, obviously there's a lot going on the macro side, and we've got this kind of competition between, no landing now and hard landing later on. Yeah. What's the trade? How do we get exposure to that sort of thing?
Well, I mean, to be honest, I'm not smart enough to position myself now for a hard landing that I see happening in the next couple of months. For me, the cleanest edge that I can see right now is still just trading it in the short term, right? Trading it out of the economic data points has been the way that I've preferred to trade this over the last couple of months, and it's worked well. So I'm just going to stick to that view. And what's nice about that as well is it keeps you nimble, because I don't have to trade that medium-term view the whole time. If the data tells me, to get short or get long, depending on how it comes out, we can trade that way. So I think right now, traders market, not investors market still.
I think that's a great point in terms of what you say about being data dependent, because we know central bankers are data dependent. So why shouldn't we be data dependent, right? The only thing that kind of what I love about all of this is the fact that we've gone from, I think the actual fact, I think it was our last conversation, maybe the three of us with Michael before, when it was like, what camps are we in? Everyone was in the hard landing. But for me, who was in the soft landing, and now we're sitting in a more rhetoric move over to the no landing. I think everyone's kind of in the brace position, whereas I'm sitting there trying to choose what my next in-flight movie is going to be. I've got from soft landing to no landing at all. I think we even you see like Hawky McHawkster, old Feds Bullard today, saying, obviously he's a non-voter, but saying his projection is basically 5.25%, 5.5%, or so 5.375.
That's where we are now.
Yeah. If he's saying basically the market is priced correctly, we're probably priced too high, because
that was his December dot though, specifically. So he may, when he comes to do the March one, he can one second, he can possibly revise that higher. And then also, I think the argument, just because he's hawkish, historically, the median is below where it is. I don't think that's quite consistent with what we've actually seen from the Fed officials, because you've seen the likes of Mester say hers is above median. We've seen Williams say 5 to 5.5%. Kashkari said 5.4%. So I think just the fact that just because he's historically a hawkish outlier, I don't think it means it's impossible the data and therefore rate hikes can catch up with him. So I don't think the median just naturally has to sit below where he is. And also specifically in that interview, he wasn't saying that was his current projection. He was just saying that's where the December dot is. And Bullard being Bullard, I wouldn't be surprised if he even revised it up higher.
So just picking up on that point, sorry, Ryan, just to interject, are you expecting there that yields have probably topped out around this on the 10-year 3.954% level, and we're going to come lower again?
Are you asking me?
Well, I'm asking anyone who wants to reply.
I think that if they haven't topped out, they should have topped out. I don't know what will happen, but in my opinion, I believe they shouldn't be going much higher than here. I think also we hear people talk about how someone like the Twitter's favorite macro bro, shall we say, have said recently that markets aren't pricing higher for longer, which is absolute balls, because
name and shame.
Well,
can you name that person? Because they could be about.
It's kind of so we say Marco Pauf.
I know.
So like a month ago, we were pricing we look at it a month ago, the curve, or the money market curve for was pricing a 4.9 high, and by the end of 9 months out was pricing like 4.5. We're now pricing
even lower. I think we were 4.4 at some stage.
Right, exactly. And now, today, we're pricing up, as we've just said, 5.25, 5.5, and in 9 months' time, we're still pricing pretty much 9.25. So anyone saying that we're not currently pricing higher for longer is completely delusional. Do you agree with it? Personally, I don't, but that doesn't change the fact that that's where the market is. So, if you do want to look to put a trade on, although I do agree with Arno completely, this isn't a market for investing. However, if you do want to, some people, they some people will want to put in longer term trades. I'd be looking to get the other side of the rates market, because I do think that, especially the back end of the curve, I think maybe it is a little bit too flat. So, that's where I'd stand on it.
No, I think that's a great shout. Adam, let's go to you. What? Obviously, the next Fed meeting is not for 3 or 4 weeks now. I think kind of mid-March. We've got Jay Powell on Capitol Hill on about the 7th of March. But between now and then, what else should we really be paying close attention to besides the obvious? Your labour market report and the next CPI number. What else should we be focusing on between now and the next Fed meeting to generate some trading ideas?
I think one thing that I've if you go back to Arno's kind of discussion on like the no landing, hard landing scenario, I think that is that's obviously this like no landing term has been like deployed recently. And there was actually quite a good piece by John Authors the other day, and he kind of makes the point that obviously no landing is a subjective classification, but let's say for argument's sake, it's growth holding up relatively well, unemployment rate rising possibly a little bit, but ultimately not too much, all of which takes place in the context of a Fed tightening cycle. And so obviously you need some independent impetus from there to kind of keep the no landing going. So that could be potentially the strength of the US consumer, the China reopening play. But I think the main thing to from this perspective to keep in mind is the inflationary backdrop in the context of this. So if you see a no landing in the context of inflation moderating, then I think central bankers will kind of see that as a success, and therefore could potentially be a bullish outcome for markets. I think the one interesting case is with no landing potentially turns to a positive growth impulse, and then we see kind of inflation not moderating, and then we get potentially a more aggressive Fed. And then there is possible that that's actually a worse outcome for the market than if you see a hard landing, but you get an accommodative Fed. So I think if this question of kind of no landing does kind of pick up a little bit, I think the focus you need to then think about is what is the FOMC's actual reaction function to that as we head into kind of Q3, Q4.
Can I just throw something out there to the room, as it were? What's people's thoughts on the notion that although central bank, the Fed should be completely data dependent. However, we know, like it or not, that they do care about their last traded price in the S&P, right? No matter how much we like to pretend they don't, they do. So is it completely crazy that you draw your line along 4,000 in the SPU? If the market's trading above 4,000 in regards to the March meeting, if the market's above 4,000 comfortably, it does bring into play a 50 hike more so. And if we're below 4,000 and the market's looking frail, come the March meeting, is it on the 22nd? I think it is. A 25% stays the most likely. As much as we hate to think that, but the fact is, it's if the market's looking incredibly robust by the time we get the next FOMC meeting, and say we are up at 4,200. No matter what the data is, I think the percentage chance, and again, I'm not saying it's most likely, but I'm just saying the chance of it increases that we do get a 50 hike. And I think market participants need to be aware that, last traded price in the SPU does impact thinking.
I think right.
Consider we're up 6% this year. I think there's plenty of scope. They'll be happy to deliver 50 basis points.
So I'm more on about like how frail the market feels at that particular point.
I think my kind of view on the fragility of the market, I think that only kind of comes into place if we get 25 March, 25 May, then 25 over June, July, because that's then 75 basis points when people were kind of primed for rate cuts coming into the year. I think that's kind of the tipping point for me. And I think by that point, they would likely pause, but then they'd probably just keep rates at where they are, but they'll also have QT run in the background. I think there's a lot of space for them to kind of throw stuff at the market. I think it's more when we get to kind of that June, July meeting, it'll become a bit more relevant for me.
The other now and then.
I'll give you 30 seconds to have the last word on that round.
Sorry, mate. The other thing just to keep in mind is, once again, coming back to the data, there's a lot that there's definitely an impact, obviously, that asset prices will have for them. But at the bottom line is, if inflation keeps at the same trend that we've seen just over the last 2 and 3 months, then it's going to get really uncomfortable for assets very, very quick as the data continues to bounce. And again, I'm assuming we get a little bit more room out of the short-term bounce and the soft data. If that happens, it's going to get really uncomfortable really quick because they don't want to see a repeat of the 70s. They don't want to see themselves doing something, stopping, and then regretting not doing more when they could have done more. And I think for them right now, that is like, that's the overarching fear that the Fed has right now, is that they have the same repeat as the 70s. They absolutely don't want to see that risk materialize.
Yeah. No, I think you're spot on there. But in the interest of time, we could talk about the Fed all day, but we've got other topics that we've got to get across. So let's move on to the second round. Oh, that's rather awkward. I was hoping the titles might roll for a bit longer so I could have a drink there, but never mind. We will get into geopolitical risk because this week is, of course, the first anniversary or the 1 year anniversary of Russia's invasion of Ukraine. Now, we've obviously got to consider the devastating human aspect and the distressing human aspect that the conflict has caused over the last 12 months. But of course, this is a financial markets program. So we need to also think about the implications that geopolitical risk there will have on markets, not only that they have had over the last 12 months, but also what may happen even when there is an escalation in the conflict, or even how things are likely to pan out over the next couple of quarters. Ryan, I know this is something that you are keen to dig into because it seems like thus far markets have kind of shrugged off any real geopolitical news of any sort over the last 3-6 months. So what are your thoughts?
Well, firstly, I think at the moment, like if you are kind of a retail trader and you're trying to work out what to follow and stuff, I think at the moment there's I've got it down as basically 4 theatres to keep an eye on. First off, you obviously, as you say, you've got the Russia-Ukraine 1 year anniversary. Hopefully we won't have a 2nd year anniversary, but who knows yet. We've also got the Russia-Moldova kind of operation, like kind of area kind of opening up, which I'll go into in a second. And obviously North Korea always on the radar. Israel and Iran is rather especially today, especially it's kind of coming back to the fore. I think anyone talking about China and Taiwan, that's not going anywhere. It's not going to kick off. But just going back, so to go through those piece by piece slightly, just to drill into them a little bit more. In terms of Russia-Ukraine, massive amounts of headline fatigue has well and truly gripped the market. It would take a hell of a lot now for a headline to move markets substantially in the in that kind of area. The market's kind of settled to the fact that unfortunately there's no sign of peace talks remotely on the table. In terms of Ukraine, the West stepping up arms production, that both sides are to center the front lines. I think it's interesting to see how the Chinese element evolves on this. Currently, they're vocally very neutral, calling for a peaceful resolution. There's no hard evidence that the Chinese are supplying Russia. Again, you can only go on we as traders should only really go on what we can kind of prove. There's loads of conjecture on both for and against this. Regarding jets and stuff, which everyone is talking about, my base case is that Ukraine does end up getting some aircraft, although it will be lighter jets from non-US countries. There's plenty of smaller kind of fighter bombers that go around. I'd be shocked if the US handed anything over directly. Instead, they're more likely to support other nations that do so via ammunition and training soldiers. Just quickly moving on to Russia, Moldova. So for those not aware, there's a very thin kind of strip of Moldova that backs onto Ukraine called Transnistria. I've butchered that.
I go on holiday every year.
Yeah, mate. Oh, it's great for skiing. Lovely skiing. Basically, that's like a breakaway area of Moldova that already has Russian troops in it. They hate Moldovans. They want to be Russian. Since 2012, Russia and Moldova have had this decree that kind of guarantees Moldovan sovereignty over that strip, no matter what happens. However, last night, it was kind of underreported, although PIQ reported it naturally because we're the best. On a par with Newsquawk, obviously.
I was going to say, did we miss it?
Yeah. That's the point. Anyway, so basically, Putin tore that decree up last night, which again, I think could be a massive deal. Well, again, it's not a massive deal until it is. My thinking behind this being quite a big deal is Putin is taking an absolute beating domestically from hardliners and nationalists in Moscow for the poor performance in Ukraine. So perhaps he can look at this new theatre of operations as a place to get some easier wins. I don't want to talk for too long, so I'll quickly go on to North Korea. Always on the radar, rarely a concern. That's your phrase you want to learn for that one. It could be changing in the near future. Obviously, they're testing some more ICBMs. Possible they're going to test I believe it's a 7th nuke. Again, apart from Japan and South Korea getting a bit concerned, wider implications, they're not really hurting anyone. Again, until they do, they're not hurting anyone. Possibly for me, the most important geopolitical risk at the moment, and it sounds weird saying it considering there is a war in Ukraine, is Israel and Iran. The reason I say this is because earlier on in the week, we learned from the UN's nuclear watchdog that they found evidence that Iran are enriching uranium up to 84%. Little fun fact for you. The bomb that was dropped on Hiroshima, a little boy, not me, the bomb, was the average enrichment of that was only 80%. So all of this crap you will hear from the armchair kind of experts that it needs to be 90% enriched before it's weapons grade, it's bollocks. Sorry, I don't know if I can say that, but it is. So huge red lines crossed for Israel. We heard this morning that Netanyahu, I think the quote was, Iran nuclear threat will not abate without a credible and serious military action. And then, which is, punchy as you like. And then we've since heard today that he's had some secret high-level talks with military officials. In terms of a trade, just quickly, go against anyone that gives you a rigid trading plan for any geopolitical risk. Every geopolitical event is different. If you have a one button to decide what you're going to do, you're going to lose money. The only people that succeed in trading headline risk like that are people with direct market access that will have a basket a trade basket lined up. They hit the button and say, like, I know, and like bad news Middle East button, and that'll be sell oil, all this different stuff. You're sitting there retail trading. As much as we'd love to think you can pick it, you'll be late, and you're trying to hit one market, which makes your job so difficult. So for me, I would sit back and assess anything that happens. Don't try and be a hero and jump on. And I'll let you talk for now.
I think you're absolutely right. And I also think that Ryan has exhausted his speaking quota for this round. Very brilliant and comprehensive analysis. Adam, let's go to you. So obviously, as Ryan said, there's a lot going on. Do you think markets actually care about any of this, or is this all just noise at the moment?
So from my perspective, I'd always kind of like to view things through an economic lens. And aside from the obvious humanitarian impact of the conflict, the reason why Russia-Ukraine was such a big market deal was because it was a further pro-inflationary shock in the wake of the pandemic. And that's kind of pretty much got us to where we are now. So obviously that 12 months on, though, the focus is very much on disinflation as, Western powers managed to wean themselves off Russian oil supplies, which we saw the success of that. For example, the other day, we saw that Russia was going to be cutting oil supply by 500,000 barrels per day in March, and the market pretty much just shrugged off it. So the main focus of the market is the disinflationary process as we kind of unwind from that. So all things equal, as long as there's no further energy impulse from Russia and Ukraine, then I think it's very much one to potentially be put on the sidelines, because I think there's other big, more important macro issues such as the Fed tightening cycle, the China reopening, etc. I think one potential angle from a geopolitical perspective with Russia-Ukraine to be kind of aware of is in case it does become a potential proxy for the US and China. I mean, with regards to kind of like missiles and kind of fighter jets, I don't know. I mean, it could happen, it might not happen. But I think one of the interesting angles and something we've been discussing on the desk is all of a sudden there seems a lot more kind of a US-China axis to the Russia-Ukraine kind of conflict now. And we saw the Deputy Treasury Secretary Adam Mayer said they could potentially sanction Chinese firms if they help the Russian war effort. So that could potentially be another angle for this conflict. And we all remember back to 2018, 2017 of US and China, where if we do kind of get to Fed terminal, then maybe potentially US-China resonates more for the market. and then also if you see other Western nations kind of follow suit and start sanctioning Chinese companies, then all of a sudden it does overshadow kind of the China reopening and global reintegration story that we kind of saw at the start of the year. So kind of my perspective is, if the disinflation process is playing out, then I think it's one to be put towards the side. But obviously keep an eye on kind of how it kind of impacts broader geopolitics, mainly US and China.
No, I think I would pretty much agree with that. Arno, are you on board with that idea as well, or would you have a different sort of steer on what's happening and how to trade it?
No, not at all. I think the guys have made some really fantastic points here. And I fully agree. I think when it comes to geopolitics, for me, I'm very much the overnight expert when it comes to geopolitical events. So take what I say with a generous pinch of salt. But in terms of where we are right now, the markets normally do this, right? The markets they're normally able to get over something fairly quickly. And obviously, when there's like Adam said, a much bigger economic aspect to it, like massive supply shock, and now we get this energy issue as well, that's always going to exacerbate the flow. But usually the markets are able to get over things fairly quickly. Now, there is obviously potential bigger risks. I mean, the one that none of us wants to see happen is for the Ukraine conflict to spill over into other borders and potentially drag in NATO. We hope that doesn't happen, but obviously if that happens, that's going to be massive for markets. There's also the other side of the coin, which right now it looks super unlikely, but a ceasefire at some stage might be possible. At this stage, it looks like the market is okay with just chugging along. That yes, this thing will just in 5 years' time we're still going to be we're still going to be seeing this playing out. But there is what if Putin has a window accident or something like that? And somebody gets replaced. What does his successor do? Does he opt for an immediate ceasefire? That can create some huge volatility. And again, bringing it back to what Adam said, now this is, I think, what the main focus will be with any type of geopolitical situation that develops is what does that mean for the current macro context? So, for example, if something happens and it doesn't really impact the inflationary story right now, if it doesn't impact, like you said, the China reopening, then it's something that's going to have a short-term play. And if you are fast enough and you're quick enough and you know exactly what you need to trade, then obviously you can get on board with that. But these types of things, in my experience, it's impossible to position yourself for them happening before it happens. And when it happens, you need to be so quick. And like Ryan said, you need to know exactly what you need to trade. Otherwise, you're going to miss the move. And if it's gone too far, the last thing that you want to do is, be the guy that sells the whole or jumps in when it's already, something has already ran 10 or 20%, because then you can get creamed if you get counter arguments coming out.
That's so a great example of that, just to back your point up, exactly that, but back to the 2 points you made up, which have been phenomenal points, is the fact of getting in late and also how quickly the market gets over it. How many times have Arno, personally, like me and Arno obviously talk, but we all talk separately as well, like socially, but how many times have we spoken about how there's over the weekend there's been something kicked off in the oil markets in the Middle East? By the time Europe gets to its desk, the market's already come back half, if not all the way. Yeah. So if you're a European trader and you're trying to get on those markets, you're doing your ass, whether you like it or not.
The classic was, I think, North Korea did some sort of huge missile test at one point. The Dow closed at 400 points.
Yeah. Exactly that. It's such a fast-moving theme, and it's one that we'll definitely stay on top of. But we are halfway through the show, so let's get on with the third round. So I'm going to go and start with the man in the cave on this round, because I'm sure he loves the UK economy more than anyone else. Let's try and dispel a little bit of doom and gloom, shall we? Because we had much better than expected PMI data coming this week. The services sector back in expansion, the composite gauge back above 50, and not all of that is due to Ryan's spending down at the Stafford. The manufacturing index, yes, it's still in contraction, but contracting at a much slower rate than we've seen before. And even the UK public finances were back in a surplus in January as well. Adam, should we all start popping the champagne and celebrating and getting long sterling, or is the market just getting a bit ahead of itself here?
Unfortunately, I think we're going to have to stick with the tap waters for now. I think if we just kind of, I know. I wish it was different, but if we kind of look at some of the data points you reference, I think there's some really interesting context, and this is where it kind of as an analyst, it really pays to kind of go beyond the kind of the number that you see on your screen and think about what the report is actually telling you. So if we start with the PMIs, and this is something I saw highlighted by Pantheon Macroeconomics, they actually only cover 51% of the UK economy. So what don't they include? Well, one thing they don't include the retail sector, which, okay, we saw that better than expected retail sales last week, but ultimately the retail sector has been getting decimated by falling real incomes. It doesn't include the construction sector, which has been impacted by higher borrowing costs, and it doesn't cover the public sector, which has been impacted by strike action. So if you kind of include what the PMIs do look at, then they're kind of consistent with growth of a staggering 0.1%, which obviously is pretty tepid. But if you do include all factors, then Pantheon says you're still going to get a Q1 outturn of minus 0.2%. So obviously the headline number, yes, it was good, but there are also sentiment reports as well. So it's more a case of things aren't as bad as we thought they were going to be, not necessarily an outright time to be bullish. And then at the risk of trying not to get too political here, when you take the public sector net borrowing data, yes, it was better than expected. But one, and this is incredibly wonky, is actually a mistake by the OBR, where they actually wrongly classified the Bank of England indemnity from the Treasury from their QE losses that distorted it. But if, okay, we do have that spending kind of surplus, that's only useful if you have a government which is A, willing to spend the money, or B, looking to offset it with kind of tax cuts somewhere along the line. And the new music from the UK government is that that's something that's not necessarily forthcoming at this stage. So in short, I wish it was better news, but it's not. If you do want one sign of positivity, the service inflation that we saw last week wasn't as bad as expected. And for people who follow the inflation data and UK rates, that's a real focus for the Bank of England. So I've entered some positivity, but I think it's more Ribena than champagne at the moment.
Yeah, indeed. I mean, your mood and your outlook for the UK economy is about as dark as your background there. Arno, I know you've been playing, you've been trying to fade some of this sterling weakness that we've seen of late. Is that something you're still looking to do, or are you starting to think that actually this weakness is justified and, things are as pessimistic as Adam said, and we should start to all pile into the other side?
Yeah, I mean, look, this is where I probably go away from being an analyst and more towards, putting a trading cap on. But one data point doesn't make a trend, right? So we're not one good PMI data point doesn't change everything. That is important to understand. However, I think the focus where I'm slightly different focus when it comes to this is looking at sentiment and positioning. That's so critical because we spoke about this in another episode as well, where we said that sentiment has been incredibly weak and bad for the UK economy. There's a ton of bad stuff that's been priced in for it. And the risk when you get to a stage where your base assumption is a super deep and long and hard recession is that if you then get even just marginal okay data, that's going to start showing you where the market is offside priced. And this is something that we've been expecting to see. And you can see based on that reaction we had in euro sterling yesterday on that PMI data point, for me, that shows that this market is still way too optimistic about the euro economy or eurozone and way too pessimistic about the UK economy. And keep in mind, it's not about, if we just get not a recession, that's already going to be so much better than what we thought we were going to get back in August and September. So I think it's the shift in sentiment for me that's the most important thing right now when it comes to sterling. And we've been looking at euro sterling short opportunities. We had a good one out of the jobs data. We had a good one yesterday out of the UK PMIs. And if the data continues to surprise this way, or if we see Eurozone data starting to surprise low, and I'll touch on that in a second, both of those can create some downside opportunities for euro sterling. I'm still waiting for anybody to tell me that they are bearish on the pair. For me, that's a good thing. I don't always want to be a contrarian, but I don't like it when if I'm long or short something and everybody else is, I normally get nervous about it. That's one thing to keep in mind as well. Now, when it comes to why I like it against the euro is plain and simple. I think a lot of we had that Europe or nothing theme going for about, 4 weeks? Now everything is quiet down. All the euro bulls are suddenly very, very quiet all of a sudden. I think a lot of the hype that was in that, Europe for longer, if you will, theme, I think a lot of that is out of has been priced in. The ECB didn't come in as aggressive as the markets thought. And if you take a look at the data, there was a lot of hype about the City Economic Surprise Index that was trending so much higher. Well, that's now pointing down, and the UK City Economic Surprise Index is now popping back up. So I think there's some differential to play here. And I completely agree with what Adam said, by the way. I think if you look under the data or under the hood, there's not a lot to be positive about, but it's more a case of we were expecting something so incredibly bad. Now we're expecting something that's just bad. And I think with the markets being clearly offside based on yesterday's euro sterling reaction, there's some short-term opportunities there to be had.
Well, I think there's some great points there. Miraculously, he's managed to be quiet for 10 minutes. So let's bring him in. Ryan, your red wine bill has probably propped up at least a couple of index points in that services.
Yeah, I don't yeah.
What are your thoughts on UK PLC?
Right. So first off, I don't know what all the doom and gloom about the UK. Yeah, if you need any guide to how great we're doing, look at JPM upgrading UK growth this morning. All right, so it was only to 0.4 from 0.1. Take the wins where you can. In terms of what Arno was saying about Team Europe have gone a bit quiet. Completely, you can't not agree with that. One thing I think we've got to remember as traders is it's all about comparison. So if you're talking about sterling, you're comparing it to dollar, or you're comparing it to the euro. So I think it's very important that I see all the time, and it's something that I've learned to not keep pulling people up on. Very kind of professional kind of people that you like in FinTwit universe and all this crap. We'll talk about one side of the currency, one side of the pair, forgetting that there is another metric at play. So if we break it down, I think
these aren't the same people who do dodgy overlay charts.
Oh God, yeah, you know the ones.
Yeah.
So
they don't wear baseball caps on Zoom calls though either. So
don't know what you're on about. No idea what you're on about. No idea what you're about. So Europe is definitely worse off than the US, in my opinion. Obviously, this is just in my opinion. The UK is definitely better off than Europe, which ties in pretty much with what Arno was saying. I think, the ECB are all over the place with their comms, even more so than normal. Then you've got Germany getting vocal against any kind of fiscal expansion as normal, but they're really kind of laying into it now, blaming the rising rates environment. Obviously, I'm perma bull on GBP at the best of times. Personally, though, I'm with what Arno was saying about long long sterling euro versus the euro. I think that's gold mine at the moment. So obviously, if that's the case, go the other way. But but I just think it's really, really important that people do remember that there is two sides to every currency pair you're trading, and it's so easy for people to forget that. And I see people forget it that should know better all the time. So
I think another point to make as well is where we're at in the tightening cycles. The Bank of England, they pulled the trigger in December 2021. ECB, it took them another 8 months. So if you're kind of looking at PMIs, there's still a lot of monetary policy transmission to kind of play its way out in the Eurozone to filter into the real economy. The Bank of England's a lot further down the line. So if at this stage of the cycle we're holding it better, then I think, it's worth not over-celebrating Europe's start to the year just because we've had lower gas prices. There's still some of that effect to be felt, and it'll be felt later, most likely more durably than the UK.
Yeah, no, I think you're absolutely right. Without further ado, then, let's get on with the last round. So, equities, the S&P, we had a pretty dismal day on Tuesday, down around 2% or so. I think it was the worst day since December for the benchmark US index. But fundamentally, we've been in a bit of a range for quite some time now, between kind of 4,000 and 4,200, pretty much since the last Fed meeting, and obviously encompassing that blowout US labour market report in the mix as well. What are we looking at to finally break this range? US equities seem to be going nowhere. European stocks are heading quite nicely higher. Obviously, the FTSE north of 8,000 last week, and the stock 600 up about 10% year to date. Ryan, what are your thoughts on the equity complex in general at the moment? Are you thinking that the range is likely to, or this downward move is likely to continue, and Europe's going to come with it? Or are we going to see quite a nice divergence play out between?
Well, I can quite easily keep this very short and sweet because I am next to useless. I'd rather pick my nose than pick equities. I said last week, I believe it was, that, or maybe the week before, that the next 500 points would be higher in the SPX. So in the SPO, the SP 500, were 100 points lower than when I said that. I'm going to dig my heels in and say that it's 600 higher before 400 lower. Nelly says buy the dip. There you go. Something that I would, is worth highlighting perhaps is the 6-month correlation between stocks and bonds is the highest in 25 years, which, it basically means that when the market's going, it's going to go. It's not like we're getting some kind of variables. I think this kind of lays things up for kind of make sure you are looking at more than just kind of your one market you trade. I think we do need to be a bit more aware of what's going on. In terms of the FTSE, you mentioned the FTSE. I hate it up here. I don't know what it is. Maybe it's the same feeling as I get when Arsenal are top of the league. I just don't feel comfortable. If spread trading is something, into contract spread is something you like doing, I would love to be short FTSE, long S&P. Maybe we need to speak to Pepperstone to kind of rig that market up. But that's my very short and sweet is stocks carry on going up. FTSE I would not be touching with with stolen money, let alone my own money. Hope that helps. It won't, but
no, I think it makes sense. I mean, you're bullish sterling, so why would you not be bearish on the FTSE given the inverse correlation we've got between the two? Ryan, not Ryan. We've spoken to you far too much in this show already. Adam, what do you think when it comes to the equity market at the moment?
I kind of think the current rally feels a little bit exhausted at this stage. I think we've kind of come quite far, considering this is taking place in the context of more aggressive Fed. I think the only thing in the short term, like the immediacy, which could possibly drive things higher, would be if we saw some of that Fed pricing taken out a little bit. But ultimately, I still don't think that's a very convincing case because of how strong the data has been. I think you need to see the data really deteriorate, which again isn't necessarily kind of like a bullish kind of outlook for the Fed. I think the downside is potentially possible, but because I think there's a lot of Wall Street analysts have said that ultimately the Fed pricing hasn't necessarily been reflected in earnings estimates. So as we head towards Q1 earnings season, which will be in April, I think it's worth keeping an eye on the estimates heading into that, because we could see things like margin compression become an increased kind of feature. If US companies are kind of unable to pass on their pricing power onto the consumer, that's something which could definitely be bearish. We've also kind of got some peripheral kind of factors to be aware of. We've got QT from the Feds running in the background, which is a liquidity draining effort. We've got the debt ceiling. I'm sure will probably be resolved, but there'll probably be some jitters along the way. And as we've mentioned quite a lot of detail, there are geopolitics. I kind of don't really see a massively convincing case for either. I think personally, we kind of just consolidate and we kind of trade this range. Then I think by the time we get to the second half of the year, I think if we've kind of weathered the Fed tightening and we kind of got a bit more clarity on where exactly terminal is, then I think a second half pickup for me is probably the most convincing case, I think.
Good stuff. I would certainly agree with that. Ryan, were you going to jump in or something?
No, just making a market going up.
I don't wonder that. I thought it was some sort of like
Just in total agreement with my good friend Adam Linton, that's all.
Appreciate it.
Arno, we will wrap up the show with you. How are you viewing the stock market at the moment? More downside, or are the bulls going to get back in control and we're going to see that 600-point rally Ryan's expecting?
Look, my answer is going to be very boring. It's going to be based on the data, I think, mate. I think if the data continues on the trend where we are right now, equities are going to struggle. And if it gets to a point where the market completely, where the market start pricing in a higher potential terminal than what the Fed is, what the bulk of the Fed hawks have said they will expect, we could easily see the lows being taken out. So for me, it's all about the data. If the data starts to deteriorate, like Adam said, massively, then you're going to have to be a short-term buyer of equities. As long as the soft data bounce continues, I think there will be struggles for equities, because again, even though a soft landing should in theory be more positive for equities, it keeps the Fed right up there. And if the Fed continues with that hiking cycle and we see rates continuing higher, like Ryan says to his point, bonds is really important for equities right now. If the data continues to surprise, we're going to see bonds continuing to sell off, and that's going to keep on pushing rates up, and it's going to keep on pushing rate volatility up. I mean, we had a huge spike. I feel, uncomfortably silly for not, noticing that spike we had to the upside in the move index over the last couple of sessions. Really, really move higher. If you looked at that, that would have already told you that there's going to be, some problems for equity. So again, the data is going to lead where the markets think money markets will go. That's going to lead where rates goes. That's going to lead where rate vol goes, and that's going to end up where we see equities eventually playing out. So medium term, I still think hard landing, like So I think there's going to be struggles for equities to keep up meaningful upside. But again, you have to keep an open mind with the data. If the data comes in and it's not the case, then we can easily see that picking up. The big risk, though, is that I see a lot of participants, like Adam and Ryan said, expecting that second year pickup. So expecting first half down, second half up. The risk is that just when everybody gets nice and super bullish at the second half of the year, that's when the labor market starts to roll over. And again, with delinquencies rising, with personal savings already down, with consumers not looking as strong as they should in terms of credit, that can be a real move lower. And that's going to suck a lot of participants in that wants to see that second half bounce playing out.
I think on the data, when you mentioned about data, I think it's very important to kind of remind people, especially people that maybe haven't been around markets for very long, or for whatever reason. Well, at the moment, we are firmly in the good data is bad news situation. And for those that have been around, as long as me. It used to be good news, good data, good news. And then after the global financial crisis, because it obviously good news meant that, aid from central banks got taken away, it became good news is bad. We were literally just getting into the good news is good news again. And then we hit COVID. It was literally like, I remember talking to people down the pub and some experienced traders down the pub. And we were saying like, oh my God, like, can you remember the last time this happened? Good news was good for markets was pre-global financial crisis. Then we hit COVID, and now we're back into well and truly that we almost came out of it for a little bit back over Christmas and stuff. But you can see by the data this week, last week, very good data will be horrendous for stocks in the immediate, in that session. I'm not saying over the course of the week or whatever, but for that immediate session where you get very good data, stock markets will tank.
Yeah. The reason why I think that's the case, and when I think that'll change, is when the focus turns away. The focus for the data right now is solely focused on what the Fed is going to do, right? Yeah. So every time we get a good print, rates go up. Bad print, rates go down. So the moment when the Fed does pause, and again, I'm not somebody that say, hey, when they pause, everything is hunky-dory and, equity just go up. But the moment when the data's focus isn't on the Fed, that is when I think equities will start trading higher on good data again. Then good data will be good, bad data will be bad. But we first need the Fed to actually put in a pause. And then I think we will see that transition again.
Yeah, no, I agree with you, Arno. And I know both of you want to talk, but Kyriakos is going to send me an angry Slack message if I don't wrap this show up very, very quickly. So, gents, let's get to the final scores. So, we've got a tie for last or second.
Second place. I think you'll find that's tied for second.
Just to be nice to Ryan, we'll give the wooden spoon to Arno. Maybe he can burn it for some power or something. Adam, congratulations. You've been on the show twice and you've won twice. So well done, mate.
I would say I'd give myself a glass of champagne to celebrate, but I've already banned myself from that. So I'll be on the Ribenas tonight celebrating.
Calm down.
Well, don't go too wild on the Ribena in the Newsquawk office. Gents, thank you as always for joining us this week. Ryan Paisey of PIQ Suite, Adam Linton from Newsquawk, Nelly the Elephant, of course, and Arno Venter from Financial Source. We will be back with another episode of Trading Blows next week. Please let us know what you think and how you're trading the markets in the comments below. But otherwise, thank you very much for watching and goodbye for now.